Every financial crisis produces the same public ritual. The retail public is told to stay calm, stay diversified, keep buying, do not panic. And then, quietly, almost invisibly, institutional capital does something else. It begins repositioning 18 to 24 months before the damage is obvious, not with panic, with hierarchy. Because when serious money senses fragility, it does not ask what might go up the fastest. It asks a colder question. What still gets paid when everything else stops getting paid? That is the pattern. Before credit stress, before layoffs, before forced selling, before bankruptcy courts start sorting winners from casualties, the wealthy move toward liquidity, legal seniority, hard collateral, and assets with inelastic demand. That is the playbook. Not because markets are unfair, because markets are not moral systems, they are transfer mechanisms. And if you study the forensic record closely enough, you begin to see that the so-called safe assets of the rich are not random at all. They are selected for one purpose: to survive the repricing of everything. The mainstream advice is designed for the median participant. Stay diversified. Don't time the market. Think long-term. For salaried professionals contributing monthly into public funds, that advice can be reasonable, but it does not describe how elite capital behaves. Because the elite do not live inside the same constraints. They have privileged access to private credit, structured deals, distressed acquisitions, tax-advantaged real assets, and, most importantly, time. They are not merely investing for upside. They are engineering position inside the legal and economic machinery of collapse. That is the distinction most people miss. The public is told to think in percentages. The wealthy think in priority of claim. The public is told to tolerate volatility. The wealthy ask whether an asset sits above equity in the waterfall, whether its cash flow is contractually protected, whether its demand is non-discretionary, and whether it can be financed or refinanced in a stressed regime. That is why the same categories keep appearing, crisis after crisis, not because billionaires are clairvoyant, because they understand structure. The first safe asset is not glamorous. It is liquidity, specifically short-duration sovereign paper and cash equivalents. This is where the public gets the story backwards. Cash is often mocked in bull markets as dead money. But during dislocation, cash stops being idle and becomes optionality. It gives you time. It gives you bargaining power. It lets you buy when everyone else is selling because they have no choice. Berkshire Hathaway is one of the clearest modern examples. In its 2025 annual report, Berkshire disclosed roughly $321.4 billion in short-term U.S. Treasury bills and $47.7 billion in cash and cash equivalents. It also states plainly that redundant liquidity is of paramount importance. That is not accidental conservatism. That is pre-positioning. When the credit cycle turns, the holders of liquidity do not merely survive, they become counterparties of last resort. In every crisis, price becomes a function of forced sellers meeting patient capital. The retail public sees fear. Institutional capital sees inventory. The second asset is gold. Not because it produces cash flow. It does not. Gold matters because it sits outside someone else's liability structure. It is one of the few financial assets that does not require corporate earnings, banking stability, or sovereign credibility to justify its existence. That is why central banks continue to hold it. The World Gold Council says central banks held around 38,670 tons of gold at the end of 2025, worth roughly $5 trillion, and that gold made up about 26% of total global allocated reserves by Q3 2025. The same source says its 2025 central bank survey found that gold's crisis performance, diversification properties, and long-term store of value function were key reasons for ownership.
Read that carefully. When the institutions that issue currency still want an asset outside currency risk, that is not nostalgia, that is reserve logic. Gold is not primarily a bet on apocalypse. It is a hedge against monetary improvisation, declining trust, and the erosion of real purchasing power under fiscal stress. In other words, it is what capital buys when it no longer wants every layer of wealth to depend on somebody else's promise. The third safe asset is farmland. Farmland is not fashionable in the way technology is fashionable. That is precisely the point. Food demand is structurally inelastic. People can postpone a car purchase. They can delay a home upgrade. They cannot permanently defer calories. And farmland is not just land. It is productive collateral tied to one of the oldest cash flow systems in human civilization. USDA data show the average value of U.S. cropland reached $5,560 per acre in 2024, up 4.7% year over year, and up 106% since 2010. USDA farm real estate averaged $4,170 per acre in 2024. USDA also reported rising cropland rental rates, meaning the asset does not merely sit there, it can be leased income. This helps explain why ultra-wealthy investors keep circling it. Bill Gates remains identified by the Land Report as America's largest private farmland owner. The point is not celebrity gossip. The point is asset design. Farmland combines hard collateral, biological necessity, and inflation-linked pricing power. In a fragile system, that combination is unusually durable. Rome understood this. Post-war elites understood this. Modern family offices understand it too. When paper claims become unstable, productive land becomes politically and financially legible again.
The fourth safe asset is prime, income-producing real estate. Not speculative towers, not over-leveraged vanity projects. Prime real estate with scarcity value, legal defensibility, and tenant demand that survives weak growth. Knight Frank's 2025 Wealth Report says 44% of global family offices are looking to increase direct real estate exposure over the next 18 months, and that direct real estate already accounts for 22.5% of the typical family office portfolio. It specifically highlights living sectors, logistics, and luxury residential as areas of demand. PwC's 2025 Global Family Office Deals Study makes the same point more bluntly. Family offices are returning to tangible value, with real assets, including real estate, regaining appeal as relative safe havens because they can produce regular cash streams. This is not hard to decode. In periods of financial fragility, elite capital prefers assets that can do three things at once: hold collateral value, generate rent, and be financed against. That trifecta matters, because real estate is not just an asset, it is also a legal wrapper around land use, lease structures, inflation pass-through, and debt capacity. That is why serious money buys the best locations, the cleanest title, and the most resilient tenants. In crisis, mediocre property becomes leverage risk. Prime property becomes monetary shelter. The fifth safe asset is not equity. It is senior secured credit. This is where the public narrative becomes dangerously incomplete. Most people think investing means owning the upside. The wealthy often prefer owning the contract, because in distress, ownership is subordinate. Claims are not. Howard Marks has spent decades explaining this. In a 2025 memo, he reiterated that Oaktree had formed a fund specifically to prepare for elevated opportunity in distressed debt during the global financial crisis. In another 2025 memo, he noted that private credit grew to perhaps $2 trillion after banks pulled back following the GFC, precisely because lenders could demand high interest rates and a high level of safety. This is the mechanism. When a company weakens, the equity holder is exposed to narrative risk. The senior lender is exposed to documentation. That is a different universe. In the bankruptcy waterfall, secured creditors stand far above common shareholders. They are closer to collateral, covenants, and recovery value. They get heard first because legally they must be. That is why elite capital likes credit ahead of crisis. It offers yield on the way in and priority if the capital structure fractures. For ordinary investors, this world is mostly inaccessible. For large pools of capital, it is one of the cleanest forms of defensive positioning available. The fifth asset appears only when conditions deteriorate: distressed debt. This is where crisis stops being a threat and becomes a sourcing channel. Marx wrote that in 2008, Oaktree had formed capital in advance for distressed debt opportunities and then deployed it when panic arrived. That is the crucial sequence. The rich do not wait for collapse and then improvise. They structure liquidity beforehand so they can buy claims after repricing. Distressed debt is powerful because it lets you acquire assets indirectly, often at a discount, through legal priority rather than open market optimism. You are not buying the story of a company. You are buying its stress, its impaired loans, its discounted bonds, its restructured claims, its future equity, transferred through insolvency. That is how fortunes are compounded during crises, not by bravery on television, by understanding that insolvency law is a conveyor belt that moves assets from weak hands to strong balance sheets. The public sees failure. Forensic capital sees transfer. The seventh safe asset is exposure to cash flows the system cannot easily do without: energy, infrastructure, defensive franchises, preferred claims on real-world demand. Again, Berkshire offers a useful window into how sophisticated capital thinks. Its 2025 annual report shows not only major exposure to Chevron among its largest holdings, but also a large position in Occidental. Berkshire owned 26.9% of Occidental common stock, held preferred stock with an aggregate liquidation value of about $8.5 billion, and those preferred shares accrue dividends at 8% per annum. That is not a meme trade. That is a structured preference for essential cash flow plus contractual economics. Energy demand can fluctuate, but modern economies cannot simply opt out of power, transport, and industrial throughput. That gives well-positioned energy assets a form of embedded relevance many businesses do not have. The same logic applies to defensive consumer franchises and indispensable infrastructure. When money tightens, discretionary stories suffer first. Necessity endures. And if you can own necessity with legal protections, dividend streams, or preferred terms, you are no longer merely hoping the market recovers. You are being paid to wait. None of this is new. The labels change. The machinery does not. In late Rome, elite wealth flowed toward land, tax privileges, and defensible claims as monetary credibility deteriorated. In Weimar Germany, financial wealth that depended on currency stability was devastated, while holders of hard assets, productive businesses, and foreign-linked stores of value had a radically different experience. In 2008, the same hierarchy reappeared in modern form. Over-leveraged households learned that nominal home ownership without balance sheet resilience is not safety. Banks learned that securitized optimism is not the same as solvency, and patient capital learned again that liquidity plus legal seniority is one of the most lethal combinations in finance. That is why every crisis feels shocking to the public, but strangely familiar to elite capital, because the forms of panic change, the order of survival does not. So here's the uncomfortable truth. The rich are not simply buying safe assets, they are buying position. Position in the payment hierarchy, position in the legal hierarchy, position in the liquidity hierarchy, position in the hierarchy of necessity itself. Cash, gold, farmland, prime real estate, senior credit, distressed claims, energy-linked and contract-protected cash flows. 7 assets, 1 logic. And once you see that logic, the mainstream script starts to sound different. Stay invested may be advice, but sometimes it's also inventory management for people above you in the capital structure. Because in every financial crisis, one group is trying to preserve exposure, and another is quietly preparing to own the fallout. So the question is no longer whether a crisis will eventually come. The question is harsher than that. When the transfer mechanism turns on again, will you be holding assets or claims on people who thought they had assets?